There is a rule that has governed your bank account since 1970. Most Americans have heard of it, the $10,000 cash reporting rule. And for decades, if you knew that number, you felt like you had a handle on how the government was watching your money. That feeling is no longer accurate. And before I say anything else, I need to stop and address the two groups of people who are about to tune out, because both of them are wrong, and both of them are at risk right now in ways they do not realize. The first group is the retiree who hears $10,000 rule and thinks, I have a modest income. I live on Social Security and maybe a small pension. I never deal with amounts that large. This has nothing to do with me. That is wrong. And I am going to show you exactly why before this video is over, because 2 of the 5 developments I am about to walk through apply directly and specifically to the retiree on a fixed income, not to wealthy people, to you. The second group is the retiree who has built up some money, a paid-off home, some savings, maybe an IRA or an investment account, and they think, I already know about the $10,000 rule. I have been careful my whole life. I am not doing anything suspicious. I am covered. That is also wrong. And it is actually the more dangerous assumption of the two. Because the people getting flagged right now, the people who end up in federal investigations over money that is completely and legally theirs, are not people who ignored this rule. They are careful, responsible people who knew about it and assumed that knowing was enough. Knowing is not enough. Not anymore. And here is why. There are 5 developments inside the current version of this system that most people, including most people who think they already understand the $10,000 rule, have never had explained to them. 5 things that are happening right now, automatically, inside the same bank account you have trusted your entire adult life. I am going to walk through all 5 one at a time. In plain English, no complicated legal language without a plain explanation sitting right next to it. And on every single one, I am going to tell you which group it hits hardest, the retiree on a fixed income or the retiree who has built up some money, because this is not a one-size situation, and I am not going to pretend it is. Stay to the end. The 5th development is the one that is quietly catching the most retirees right now. It feels completely innocent when you are in the middle of it, and it is also the easiest of all 5 to protect yourself from once you know what to look for. Let us start. Development 1. There is a second report, with no dollar limit, and your bank cannot legally tell you it exists. Most people know about the Currency Transaction Report, the CTR. Your bank files it automatically anytime you make a cash transaction over $10,000. It goes to the federal government. That part most people have heard of. What almost nobody has heard of is the second report, the one that has been running quietly alongside the CTR for years, the one that has no minimum dollar amount, no threshold, no floor. Your bank can file this report on a deposit of $5,000, $500. There is no number low enough to be automatically safe from it. It is called a Suspicious Activity Report, IACIAHI. And the difference between a CTR and a SAR is enormous. A CTR is routine. It fires automatically on every cash transaction over $10,000 regardless of who you are. It is not an accusation. It is not a red flag. It is paperwork. Millions of them are filed every year on completely innocent transactions, and the vast majority go absolutely nowhere. A SAR is different. A SAR is targeted. When a SAR gets filed, it means the bank system looked at your account specifically and decided your financial behavior was worth reporting to the federal government. That report contains your name, your account number, and a detailed written description of exactly what triggered the flag. And here is the piece that I think should genuinely make every person watching this stop and think. Your bank is legally forbidden from telling you a SAR has been filed. Not discouraged, not advised against it. Forbidden by federal law. It is an actual crime for a bank employee to tell a customer that a suspicious activity report has been submitted on their account. Your banker could have known you for 20, 30 years, could know with complete certainty that you are one of the most honest, careful people they have ever served. They still cannot warn you. They cannot leave you a note. They cannot give you any signal at all that it happened. You could have a report with your name on it sitting in a federal database right now and have no idea. Now here is how this breaks down for both groups. For the retiree on a fixed income, you are not off the hook just because your amounts are small. The SAR has no minimum. A pattern of modest transactions can trigger it just as easily as a large one. In fact, the software watches modest fixed income accounts specifically because the patterns are predictable. Any break in that pattern gets noticed. For the retiree with savings, you are more exposed than you think. The more money moving through your account, the more data the system has to build a picture of your behavior. And the more data it has, the more precisely it can detect when something breaks the pattern. Both groups, different reasons. Same report. That is Development 1. Development 2. 4 ordinary retirement habits are on the government's trigger list. The suspicious activity report does not get filed randomly. It gets filed because the bank's system detected a specific pattern. And this is the part of this video that I most need you to sit with. Because the 4 patterns that most commonly trigger a SAR are not the patterns of criminals. They are the patterns of careful, cautious, honest, retired Americans who are doing exactly what they have always done. The first pattern is structuring. This is the most serious one legally and the one that has destroyed the most lives. Structuring means breaking up cash transactions deliberately to stay below the $10,000 reporting threshold. Multiple deposits of $9,000 or $8,400 followed by $9,100 followed by $9,600 spread across a few weeks. The algorithm does not need to catch you in the act. It looks at your entire account history and recognizes the shape. And here's the legal reality that most people never fully understand. Structuring is a federal crime under 31 U.S.C. 5324. Not because the money is dirty, not because you owe taxes. The act of breaking up deposits to avoid the reporting threshold is the crime itself, completely separate from what the money is or where it came from. The penalties are severe. Up to 5 years in federal prison, up to $250,000 in fines. And the government can seize your money through civil asset forfeiture before any criminal charge is ever filed, before you have had a single day in court. For the retiree on a fixed income, this pattern is most likely to appear when you receive a lump sum, an inheritance, a gift from family, money from selling personal belongings, and try to deposit it carefully in smaller amounts. The intention is caution. The legal result is a federal crime. For the retiree with savings, this pattern often appears during account consolidation, moving money from one bank to another in pieces over several weeks. Completely innocent, legally dangerous. The second pattern is sudden changes in account activity. If your account has been steady and quiet for years, Social Security arriving on the same day every month, the same modest withdrawals for groceries and utilities and bills, and then a large cash deposit arrives, that single change in the pattern can trigger a review. Not because large deposits are illegal, because the change is what the system is trained to notice. For the retiree on a fixed income, this is the inheritance or the gift that arrives when you are least expecting the scrutiny that comes with it. For the retiree with savings, this is the home sale proceeds, the pension lump sum, the IRA withdrawal that lands differently than your account's history suggests it should. The third pattern is round number cash withdrawals made regularly. If you take out $500 every week or $1,000 every 2 weeks, because you prefer cash, because that is how you have always handled certain expenses, that consistent rhythm of identical round numbers can look like deliberate structuring to software that has no knowledge of your habits. This one hits the retiree on a fixed income hardest. Regular modest cash withdrawals for everyday expenses, the pattern of a careful, budget-conscious person, flagged as suspicious by a system that does not know the difference. The fourth pattern is account activity that does not match your customer profile. Banks build a behavioral model of every customer. Retired, fixed income, modest and predictable transactions. If something breaks that model, a wire transfer you have never received before, a large third-party payment, anything that does not fit, the mismatch itself triggers a review, not the amount, the difference from what the system expects from you specifically. For both groups, the implication is the same. The longer you have banked somewhere, the more precisely the system knows you're normal. And the more precisely it knows you're normal, the easier it is for anything unusual to stand out. 4 patterns, all of them ordinary, none of them requiring any illegal intention, and not one of them will come with a warning when they fire. That is development 2. Development 3. The technology watching your account today is not the technology that existed when you learned this rule. This is the development that makes everything else worse, and it is the one that most directly explains why something that felt manageable 5 years ago may not be manageable the same way today. For most of the history of bank reporting, the monitoring system had real limits. A CTR fired automatically above $10,000. A human compliance officer looked at accounts periodically and filed a SAR when something stood out to them personally. The system had fixed rules and the natural limitations that come with human attention and human hours. That system is gone. The software running on your bank account today uses machine learning. It does not apply a list of fixed rules. It learns. It builds an individual behavioral model for each customer and updates it continuously. It compares everything happening in your account right now against everything that has ever happened in your account. It analyzes patterns across hundreds of thousands of accounts simultaneously and spots anomalies that no human being looking at one account at a time would ever catch. What this means in plain language is that the system is no longer limited by what a person can notice. It is limited only by what the data contains, and it has a great deal of data. For the retiree on a fixed income, this matters because fixed income accounts are among the most predictable accounts in any bank system. The pattern is established quickly and established clearly. Any deviation from that pattern, however small, however innocent, is visible to software that has been trained to treat deviation as a signal worth examining. For the retiree with savings, this matters because more financial activity means more data points. More data points mean a more detailed behavioral model. And a more detailed model means the system can detect subtler and subtler variations from your established pattern over time. This increased capability is documented. It appears in federal regulatory guidance. It appears in banking industry reports. It has been discussed in congressional hearings. The sophistication of these systems has increased every single year for the past decade, and it will keep increasing. The honest implication for everyone watching this is straightforward. The habits that went unnoticed before may not continue to go unnoticed. Not because you changed anything, because the system watching you did. That is development 3. Development 4. Congress is actively trying to lower the threshold, and nearly succeeded. Now I want to talk about what happened in Washington a few years ago, and what is still being discussed today. Because most people do not pay attention to financial legislation until it is already law. And by then there is nothing left to do except adjust. In 2021, during the debate over a large spending package, there was a serious proposal to require banks to report to the IRS the total annual inflows and outflows of any account with more than $600 in activity across the entire year. Not $600 in a single transaction. $600 over 12 months. That threshold would have swept up virtually every bank account in the country. Think about what that would mean for a retiree on a fixed income. Your Social Security arrives every month. Your electric bill comes out. Your grocery runs go through. You are over $600 in annual activity in the first week of January. Under that proposal, every dollar moving through your account would have been reported to the IRS automatically. Not suspected, not flagged, reported. Routinely. As a matter of policy, that proposal did not pass. Public opposition was fierce and the provision was stripped from the final legislation. But here's what I need you to understand about that. The people who proposed it did not disappear. The argument they made, that the government is losing hundreds of billions of dollars a year in uncollected taxes and that expanded bank reporting would help recover it, that argument is still being made in Washington today. Revised versions of this proposal continue to be discussed. The number changes, the categories shift, the underlying push has not stopped. For the retiree on a fixed income, the $600 proposal would have been the more immediate threat. Every ordinary transaction reportable. Every month of living on a fixed income visible to the federal government in detail. For the retiree with savings, the threat is the combined effect. More reporting feeding, more sophisticated monitoring, feeding more SAR filings on accounts that were previously below the system's attention threshold. There is also currently a proposal called the Streamline Act, introduced in late 2025, that would raise the CTR threshold from $10,000 to $30,000. That bill has not passed. But its existence confirms something important. This rule is being actively debated in both directions at the same time. It is not settled. It is a live conversation with real consequences for real people, depending on which direction it moves. The $10,000 threshold has not changed today, but it has come closer to changing than most people realize. And the conversation about changing it is not over. That is development 4. Development 5. 5 moments in retirement life where the wrong move can cost everything. This is the one I told you to stay for, because the first 4 developments are about the system. This one is about you. Specifically, the moments that come up in ordinary retirement life where the rules I just explained become real and immediate and personal. There are 5 situations. I am going to give you each one the same way. Here's what happens. Here's what people do wrong. Here's exactly what to do instead. Situation 1, you receive an inheritance. Your parent or a sibling passes away and leaves you money. Maybe $25,000. Maybe more. It arrives as a check from the estate, or in some cases as cash. You take it to the bank. What people do wrong, they worry about the size and break the deposit into smaller amounts across multiple trips. That is structuring. It is a federal crime. The money being clean does not change that. What to do instead? Deposit the full amount in one transaction. Bring whatever estate documentation you have. A copy of the will, a letter from the executor, anything showing where the money came from. If the teller asks, you say one sentence. I received an inheritance. You hand over the document. You keep a copy at home. That currency transaction report gets filed if it is over $10,000. It is nothing. It is a record with a clean explanation behind it that no one will ever need to question. For the retiree on a fixed income, this situation is especially urgent because an inheritance may be the largest single deposit your account has ever seen. The change in pattern is visible. The documentation is your protection. For the retiree with savings, the same rule applies. Size does not create safety. Documentation does. Situation 2. You sell your home. You sell a house you have lived in for decades. The proceeds arrive as a wire or check from a title company. You bring that money to your bank. What people do wrong, they are startled by the size of the number and start moving it between accounts in smaller pieces to make it feel less conspicuous. What to do instead? Leave it alone. A wire from a title company is one of the most thoroughly documented transactions that exists. The title company has records. The government recorded the sale. Your closing statement documents every single dollar. With that paperwork, a deposit of any size has a complete, irrefutable explanation already attached to it before you walk into the bank. Do not create movement where none needs to exist. For the retiree on a fixed income, selling a home may be a once-in-a-lifetime transaction, one that produces more money at once than has ever moved through your account. The documentation that comes with the sale is your protection. Keep that closing statement in a safe place permanently. For the retiree with savings, the home sale may be one of several large transactions in a year. Each one needs its own documentation kept separately and clearly. Situation 3. Your children give you money. Your adult children want to help you. They give you cash or send a transfer for medical bills, home repairs, everyday needs. This is a gift. Gifts are not taxable income to the person receiving them. What people do wrong, they have heard something vague about gift taxes at some point and start keeping amounts under some number they half remember, spreading money across weeks or months. That creates a pattern. That pattern has a name. That name is structuring. What to do instead? Understand the real rule. In 2025, any person can give up to $19,000 per recipient per year with no reporting requirement at all. Above that, the giver may need to file a form, but any tax on that falls on the giver, not you. Have your child write one paragraph. Their name, your name, the amount, the date. One sentence saying it is a gift with no repayment expected. Keep that letter. Deposit the full amount at once. That is the entire process. This situation hits the retiree on a fixed income particularly hard because help from family is often a lifeline. The last thing it should ever become is a legal problem. Situation 4. You consolidate your bank accounts. You want to simplify your finances. You have accounts at 2 or 3 different banks, opened over decades of life changes. And you want everything in one place. So you start moving money a little at a time over several weeks. What people do wrong, they do it gradually in small amounts, thinking modesty equals safety. The bank's monitoring software sees a pattern of repeated, unusual deposits that do not match the account's established history. It does not know you are simplifying your finances. It sees what it was trained to see. What to do instead? One wire transfer per account being closed. Full balance transferred directly. Keep the closing statement from each account you close. One clean transfer per account. That is a completely routine banking transaction with an obvious explanation and no pattern for the system to flag. For the retiree on a fixed income, this often comes after a major life event, the loss of a spouse, a move to a new home, a decision to simplify. It is already a hard time. A legal problem on top of it is entirely avoidable with one phone call to your bank, explaining what you are doing, and one transfer done correctly. For the retiree with savings, consolidating larger amounts makes the individual transfers larger. Larger transfers are more visible. Documentation and simplicity matter even more. Situation 5. You receive a Social Security lump sum. If you delayed claiming Social Security, you may receive a retroactive payment covering several months of benefits at once. Depending on your monthly amount, that lump sum can easily be $12,000, $15,000 or more. What people do wrong, they are surprised by the size of a government deposit that is larger than anything they are used to receiving, and they start redistributing it, moving portions to savings to other accounts into smaller amounts, trying to spread it out so it feels less conspicuous. What to do instead? Leave it exactly where it lands. The Social Security Administration has a record of every payment they issued. Your bank has a record of the deposit. Those two records match perfectly and tell a complete, irrefutable story without you doing a single additional thing. The moment you start moving that money in pieces, you create exactly the pattern the system was built to detect. Leave it. The documentation exists automatically. This situation hits the retiree on a fixed income hardest because a Social Security lump sum may be the largest single deposit you have ever received. The instinct to manage it carefully is completely understandable. The way to act on that instinct is documentation and stillness, not movement. What to say at the bank window. One more thing before the action steps. The moment a teller asks about a large deposit, it happens. It will happen. And it is the moment a lot of retirees freeze and accidentally say the wrong thing. Answer in one sentence. Sold a car. Gift from my son. Closed an account at another bank. Received an inheritance. One sentence. Truthful. Calm. Then stop talking. Do not apologize for the size of the deposit. Do not explain your entire financial history. Do not say anything about hoping to avoid a report or not being sure if you should split it up. Those words, even said with pure innocence, can end up in a written compliance note that follows your account. Hand over your documentation, take your receipt, leave. And if a teller ever suggests splitting the deposit into smaller amounts, the answer is no. Every time, without discussion. That suggestion, however kindly it is offered, leads directly to the pattern that structuring law was written to prosecute. This system was not built to target retirees. It was built to catch serious financial crime, real crimes. But it is automated. It is expanding. And it does not know you. It does not know you raised a family on that money. It does not know the $14,000 you deposited came from selling a car you drove for 15 years. It does not know the pattern of transfers last winter happened because you were trying to simplify your finances after your husband passed. It sees numbers. It sees patterns. When those numbers and patterns match what it was trained to flag, it flags. Without knowing your name in any meaningful sense. Without caring about the honest life behind every dollar. The burden of making yourself known, of supplying the context the system cannot see, falls entirely on you. And the only way to supply it is documentation. That is the whole lesson. Not fear, not distrust of your bank. Just the simple understanding that an automated system requires you to speak for yourself. And that speaking for yourself, in this context, means keeping a folder with 4 pieces of paper. Here is what to do this week. 1. Start the transaction records folder today. Put something in it right now, even a note about a recent deposit. Make it real before you need it. 2. Think back over the past year. Any large cash deposits? Do you have documentation of the source? If not, write a dated note now in your own words while you still remember the details. 3. If you are consolidating accounts, do it in single full transfers. 1 transfer per account. Keep the closing statement from every account you close. 4. If a large cash event is coming, a home sale, an inheritance, a pension payment, gather your documentation before the money arrives. Know exactly what paperwork you will have and where it will live. 5. If you have ever broken up deposits to stay under $10,000, even with money that is completely yours and completely clean, do not do it again. 1 deposit, full amount, documented source, every single time. Here is what I want you to take from this video. The $10,000 rule did not get worse because the number changed. It got worse because the second report, the suspicious activity report with no dollar minimum and a legal gag on everyone who files it, is now powered by software that sees things no human reviewer would ever catch. Because 4 completely ordinary retirement habits are sitting on a list of triggers the system watches for every day. Because Congress came closer than most people realized to sweeping every ordinary bank account in the country into expanded federal reporting. And because the habits that went unnoticed before are no longer guaranteed to go unnoticed today. None of that is a reason to be afraid of your own savings. It is a reason to understand the system those savings live inside. You now know all 5 developments. You know what triggers a flag. You know which situations catch retirees most often and exactly what to do in each one. And you know the simple 10-minute habit that protects all of it. The system does not know who you are. Your documentation does. So before you close this video, think of 1 person in your life who is over 60. A parent, a sibling, a neighbor, a friend from church, someone who handles cash, who has recently received a large payment, who has ever thought about splitting up a deposit to stay under a threshold. Send them this video. Because every one of those 5 developments applies to them right now, whether they know it or not. And knowing is the only thing that actually protects you. Drop your questions in the comments. I will see you in the next one.